Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and as always, delighted to have you with us. We are going to take a look today at how the game has changed and look at 6 strategies to navigate risk in 2024. And with us today is Brandon Cobb, and he was a former medical device sales rep before becoming a fund manager in Nashville, Tennessee, annually managing over $22 million of new first-time home buyer housing and build-to-rent communities. Quite an accomplishment in and of itself. So Brandon, take us into the show and share with us, why did you leave medical device sales and go into the real estate industry?
Yeah, well, hey, Dr. Allen, it's a pleasure having you on the show, and it's great to connect. You know, I didn't have a choice. The last words I heard were, Brandon, we no longer think that you're a good fit for us. And I hope that you learned something from this. And with that, my medical device sales career was over. That happened on one sunny Friday afternoon around 4 p.m. After a great day at the OR, best possible day a sales rep could have had. And I never had any kind of aspirations to be an entrepreneur. Real estate wasn't on the radar. I loved what I did. I thought I was the coolest kid on the block, got his mid-20s, wearing scrubs every single day, rubbing shoulders with orthopedic surgeons, getting to train hospital staff on my product. I got to be in an industry where I felt like my product was making a difference. I was very intrinsically motivated. I really liked that. And probably like a lot of young 20-year-olds, guys in their mid-20s, I just wanted to make my parents proud, right? I wanted to have a good, safe career, follow in their footsteps, stacked away all my money in my 401k, started doing an HSA, like really taking the whole tax efficiency thing and, you know, doing everything that my parents told me I needed to do to live a really great life and retire. And my boss was a guy at the time I really looked up to. He was somebody that I aspired to be. You know, I wanted to, eventually, take his job, and I would tell him that. And, he was the guy that really gave me a shot into breaking into medical device sales. It's a very difficult field to break into. It was my dream to get that job. It took me a long time to break into. And so when he was firing me, it felt like I was being abandoned. And I didn't really know where to turn. So it became pretty depressing there for a little bit. But I gave myself a 6-month ultimatum. I started going to a lot of real estate meetups. I started reading. I had these other businesses that I had started that as soon as I saw the real estate business take off, I cut those off and said, I'm just going to focus on real estate. And what started as a small little house flipping business grew into a vertically integrated house flipping business that grew into a vertically integrated new construction company. And that eventually morphed into a land development company and new construction company where we just focus on entry-level housing. When I say entry-level housing, I mean these communities where people are able to purchase their first home, right? A $2,500 per month mortgage, because that asset class just seems like it's got a fantastic runway, and we've had a lot of success with it. But yeah, not a natural entrepreneur. Definitely did not see myself jumping into real estate 8 years ago.
Yeah. Well, you've certainly made a very successful transformation. There's several things about that are impressive to me. I mean, one is that it came out of the blue, something totally and completely unexpected, and you gave yourself 6 months. That's a very, very short transition period there, certainly to turn that around and to do it successfully. So what was your secret really to being able to go from that moment of shock to 6 months later starting what became a very successful entrepreneurial experience?
You know, I don't know that there's one secret that you can pinpoint and say, this is the reason that it was a success. I gave it a shot. I believe that it could happen. I burned the bridges. If you talk to a lot of people when you start some new venture, they always give you this advice that's, well, work your job and do a side hustle. And once the side hustle makes enough money, then you can, quit your day job and kind of do that. And that's a long process that does work. It's good advice. It's safe advice. I want to tell this person to do that because if I tell them the more extreme version, just burn the boats, quit and go full on in, and it doesn't work out, then they're going to get burned, and I don't want them to take that kind of advice because it's pretty harsh. I burn the boats, and I do that with everything that I do. I don't have a plan B because it distracts me from plan A. Now, of course, a guy, 26 years old, single, no kids. I had no bad debt. I had about $111,000 in savings and had all these retirement accounts. I had a safety net, right? So it's easy for me to swallow that pill and say burn the boats and go after it. The real learning really didn't take place till about 2 years in, until I had burned through that $111,000. I had sold all my retirement accounts and there was nothing, and I had $98,000 of credit card debt. So the 2 years taught me, okay, here's how to blow all your money and do it the wrong way. And the real learning didn't take place until I had not only exhausted all of my retirement accounts and all my money, but I had $98,000 in credit card bills that I was not sure how to pay. At that moment, the economy, the market, my business forced me to start becoming a business owner and somebody that's just trying it out. Because when you got lots of money, you can feed something, but just because you have something, it's just you have a watch that's turning. If you've got the cogs of the wheel of the machine that are turning as you're feeding it money, doesn't mean that it's actually a business, that it's actually producing something. And so that was a very pivotal moment when that happened.
Well, that interesting. That really brings more context to that whole entire experience. You didn't have mentors growing up, like most people don't. We're taught to go into the workforce and be good workers, and very few of us have mentors or teachers that are going to teach us how to take that entrepreneurial direction. And so it's not surprising to me that you had this fairly nice, substantial wad of cash, and in 2 years you burnt through it because you didn't have anyone really guiding you to do anything other than to do that. So you find yourself here. You burnt through the resources. You have $98,000 in credit card debt. What opened the door to actually turning that into a business?
So here's where we get to the good stuff. You asked what the secret was. How did you, start your business? I don't think there was a secret to that. It's just burn the bridges and let's go. Let's give it a shot. But there is secret. There is a blueprint. There is a process to running a successful business. And what I did was I started getting in rooms with people who had accomplished what I wanted to accomplish. I had paid for mentorship. So part of that credit card debt that I was telling you about, that was a $25,000 mastermind course that I took to be in a group of people who were flipping houses. They were wholesaling houses. They were doing what I wanted to do. They had the blueprint. There were people just starting out, people like me that had made it a little ways, and there were people that were flipping 200-300 properties per year and making lots of money doing it. Getting around people like that was the key for me. Paying for that coaching, paying for that mentorship. When you're part of groups, and those groups have a culture of just giving, each business owner does something really well. They have something unique about their business that they're very good at. They also have a certain amount of problems that they have. And what you'll find is when you're part of these groups, or it could be a group of doctors or a group of lawyers, some kind of mastermind group where everybody has said, we want to give, and we believe that we can help each other as a community grow, as opposed to just holding all of our secrets to our chest. When you do that, your skill set, what you're doing really well, that's going to help somebody else solve a major problem they have. And vice versa, your problems that you have, somebody else has probably most likely figured out how to solve that problem, and their skill set can help you solve that issue. So there's a very beautiful thing. Being a part of these communities, these mastermind communities of other entrepreneurs, that has really helped catapult us. And even today, I still take my own advice. I have a guy that I pay $2,500 a day. He flies into town 6 days a month, and he shadows me. He has built and sold a $100 million real estate development business. Those are the kind of people that I want around me. He's not cheap, but he's done the thing that I'm trying to do. And so if there's any secret sauce, I think, to building a business or being successful, it's figuring out who's already accomplished what you're trying to do and figuring out some way to get around that person, pay them, add value to them, whatever that is. And that in itself of alone, if you can get them invested in your success, you will be successful.
Well, going into kind of the nitty-gritty of the topic we said we were going to talk about, which is risk and risk management, what are the 6 layers of protection investors should be incorporating into whatever deal it is that they're going into?
Yeah, so we've got these 6, and let me be very clear. The game has changed since interest rates have rose completely. The market's shifted. Before you had this huge interest rate rise, capital was available. I was getting mailers from lenders wanting to lend me money. Deals were very hard to come by. Houses and assets were selling immediately on the single family market. You had people who had a 4, 5, 6 year pro forma to flip and sell an apartment complex happening in a year or two. Like I was in syndications that were only a year and a half long. I mean, it was crazy back then. The game has changed, and so the rules have changed, therefore the risks have changed. And so here's 6 things that we started implementing in 2024 that have been real game changers for us. And these are the 6 strategies we're using to mitigate risk. Number 1 is we want to have multiple exit strategies lined up. Now, you hear this all the time, but a lot of asset classes don't offer multiple exit strategies. And so for us and what we do with our umbrella, everything falls under that entry-level housing asset class. When I say entry-level housing, I'm talking about that $2,200 to $2,500 per month mortgage note, right? In my market, that's a home between the $300,000 and $500,000 range. That's the first-time home buyer home. That's what a new family can afford to buy. And so what we do is we go out and we work with the local municipalities, and we pull a chair up on the same side of the table, and we say, hey, what's lacking in the community? What developers have done a really good job working with you guys? What developers have not done a really good job? What are the citizens complaining about? And they'll tell us. Rather than us coming and trying to shove like a piece of land down their throat, we want to be on the same side of the table as the city, and we want to try to help build the vision in the community for them. And so that's step number 1. And so we'll actually go out and we'll put parcels of land under contract, and we force appreciate the value of that land before we buy it. So kind of similar to like a multifamily where you buy it, you renovate it, you increase the rents, you reduce the OPEX, you increase the NOI, and that force appreciates the value of the property. Or you buy a house and you fix it up and you force appreciate that value. We do that with land through a rezone or entitlement process. In other words, we take farmland and we create new communities out of. And so we create massive equity in this land while it's under contract, and then we go in once the value has been created and we have approvals in place from the city and the state, and we will purchase that land, and then we will do one of 3 different exit strategies. We'll either land bank it with our investors. Let's say we've got about 100, 200, 400 homes that are about to go up around that piece of land. We'll just land bank it with our investors, hang on to it for a year or 2. It'll go up even more, and then we'll sell it to another developer. Exit strategy number 2 is we will actually develop that land and we'll sell it to a builder. So we'll take a piece of raw land, we'll put the water, we'll put the utilities, we'll put the roads in, we'll make a nice clean community without the houses. And then we'll sell that community to a Lennar, a D.R. Horton, some big national home builder. And the cool thing about it is when we do these developments, we already have them under contract. All these builders right now, they cannot get enough inventory. Everybody stopped buying from July of 2022 to June of 2023. And so there's this massive inventory shortage. And so that's exit strategy number 2. We'll contract, develop, and then sell these lots to other builders. And then exit strategy number 3, let's say the builder falls out for whatever reason, something happens. If we own these developments outright with our investor partners, then that allows us to use all that equity to go get debt financing and start building and selling the homes. And so those are the 3 different exit strategies that we have. And that's exit strategy number 1. I'll kind of pause. I'll pause right there. That's risk strategy mitigation number 1.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. So yes, Rick, multiple exit strategies are a critical aspect of risk mitigation. And that took me a long time to learn that. But yes, it is critical because we never know the future. And if we have a variety of exit strategies, we can generally come out of it pretty good no matter what direction the future leads us to. And so let's go on. What's number 2?
Exit strategies number 2 and number 3 are kind of similar, but they're nuanced. You need to be able to control the debt, and you need to be able to have the ability to hold the asset. So those 2 kind of go intertwined. Your biggest risk is the debt, running out of money to pay the monthly payments, or having the lender call your note due. Not many people talk about that risk a lot. You can have an asset that's doing perfectly well. You've paid the bills on time, but you have some crazy economic event. I know we've never seen anything like this, like a banking crisis where the banks get squeezed and they go, hey, we're calling the note due. And you might go, well, wait a minute. I've paid all my bills. Why are you doing this? Huge risk factor. And so we own these developments outright with our investor partners all the way up until we choose to build the houses. If we go that route and we're going exit strategy number 3, then we know we're going to introduce some debt. And typically we want to be in and out in about 12 months. We want to be very, very quick with that. And we've got a lot of liquidity on hand. So if you've got the ability to control the debt, either via raising private capital for debt or not using traditional bank financing, going a private lender route where they'll give you, like a 3-year loan on something that's only going to take a year, well, then that's helping mitigate that time risk. You've got the ability to hold that asset a lot longer, and you've got the ability to control that debt. So those are 2 and 3. Now, number 4, we've kind of touched on a little bit, but you need to have some ability to force appreciate that asset. And depending on where that forced appreciation happens in the sell cycle makes a difference. So in the multifamily world, usually it's happening after you renovate and increase the rents. Now, sometimes you can walk into an asset and have immediate equity. That's my favorite kind of deal. And so what we do is we might take a piece of land that's worth $600,000, $700,000, $800,000 and come to the seller and go, hey, how would you like $1.2 million for it? And they'll go, well, how are you going to do that? And then we explain, well, we're going to take your farmland and we're going to put 100 homes on it, which is going to make it more valuable. And so what we do is we're able to have a very compelling value proposition to the landowners that we go after because we're adding so much value, but it also builds a ton of equity in for ourselves. And so really, our risk is just paying for some of the civil engineering and design fees and the sweat equity to get the approvals with the city. And once we've done that and we've forced appreciated this land, now we can go in with our partners and say, hey, let's raise some money, let's buy this piece of land. And because we've got a ton of equity that's built into it. And the great part is, if for whatever reason you have some kind of big economic event, you've got the ability to hang on to it because you own it outright with your investor partners. We're developing a 75-home site right now. We're in and around just west of Nashville, Tennessee. We've got all the lots contracted to sell as soon as they're done. We bought that in September of 2022. Probably the worst time you could have bought something. All the buyers flocked to the sidelines. All the builders said, "Oh, we're on hold. We're not buying anything." Everything froze for nearly 9 months after that. But because we bought it with our investor partners, we didn't have any bank risk, debt on it. We could hold that asset. We were fine. And so now things bounce back. Market's chugging along. We were able to say, all right, let's ready, set, go. And so we're able to do that. So that's the fourth one. You want to make sure that you can do some forced asset appreciation. I'll kind of pause there and let you make what other comments before we go to the last two.
Well, all of those are interesting, and whether it is the single family or the land or the multifamily or other commercial assets, these are important risk mitigation strategies to use. And they're very good questions for any passive investor to be looking at and asking the operators, whether they're operating like you or whether they're doing syndications like we do. They're critical questions. So what are the last two?
The last two are you want your end buyer lined up and you want some downside protection. And when I say some, I mean a lot. So having your end buyer lined up. One of the beautiful things about these three different exit strategies that we have is we have the ability to not speculate. We have the ability to have the buyer immediately lined up. So the year it takes to go in and do all the entitlements and the design work for these developments, we could go be shopping for a developer to buy it once it's done and have them lined up already. If we're going to be the developer and develop and sell these pads to a builder, it gives us time to line that builder up and contract with them. If we're going to build and sell the finished homes, we had several communities that sold to build to rent funds where once you've built it, you can immediately they'll buy it in one fell swoop. They'll pay cash for it. And so that eliminates I wouldn't say the market risk because things can change while you're entitling it or getting it done, but it eliminates the time risk, right? When you flip a house and you put it on the market, there's a time risk associated with that. You're speculating to a certain extent. Hopefully you're taking into account other variables, comparables, absorption rates, the number of other homes on the market, et cetera, when you put that home on the market to help mitigate that time risk. But every minute that your asset sits on the market complete, ready to be purchased, and it's not being purchased, that is a risk that you open up the door to. And so we try to mitigate that by having the end buyer lined up. And then the sixth is downside protection. These 75 lots that I was telling you about that we're currently developing, we're under contract for $85,000 per lot, and our cost basis is $63,000. And so you'd have to have a 25% reduction in the price of that asset just for us to break even. In the multifamily world right now, I love multifamily, by the way. I actually invest in multifamily. I'm just using this as an example. But right now, with what's happened with interest rates, and unfortunately, a lot of people took out a lot of bridge debt, and a lot of people are really feeling that because they can't refinance their bridge debt out, and they're either getting capital calls or having to come to the table with some rescue pref equity. There's bloodbaths going on right now because these assets are at a 30% discount and they're not able to refinance out. Great buying opportunity for others, though. I think right now we'll be looking back 10, 15 years from now and seeing this as another 08, 09 opportunity to buy multifamily real estate. But that 30% decline, it's causing a lot of personal bankruptcies. A lot of people are having to turn the keys back over. If I had a 25%, 30% decline right now, I would break even, right? Everybody would get their money back. It would be okay, and that would be a scenario. So I feel very good about what we're doing because we're building in a lot of downside protection, and we're doing that before we buy the asset.
Well, excellent strategies there. So, Brandon, tell us about your company and how people can get involved with you.
Yeah, so I'm the co-owner of HBG Capital. We're a real estate investment firm that primarily invests in entry-level housing opportunities here in Middle Tennessee. If you're somebody who's trying to learn more about investing in real estate, if you're interested in building a legacy, if you're trying to make an impact, if you're trying to do something where you're replacing your job income or business income with real estate income, you can head on over to our website, hbgcapital.net. That's pronounced Harry Bob Gary Capital.net. I joked that the .com was stolen, so the .net was left. On that website, we've got a free ebook, 100 questions business owners ask before investing. I wrote that ebook after a phone call that I got one day from one of our current investors, asking if I'd be willing to take a phone call from his friend who lost 100% of his investment in a real estate deal. And within a few minutes being on the phone with this gentleman, he didn't have many options. He didn't properly secure his investment. He didn't know how to do the due diligence on the deal. He didn't know how to do the due diligence on the operator. But had he asked the right questions unlock the answers we need to make more informed investment decisions. And I'm 100% sure that had he been able to ask the right questions, he would have been able to get the answers he needed to make a more informed investment decision, and he would not have lost all his money on that deal. So you can grab that ebook on our website, hbgcapital.net. There's a ton of other free educational resources on there. We've also got our own podcast called the Recession Resistant Real Estate Radio, where we talk about entrepreneurship, growing businesses, investing, and real estate. You can check us out there too.
Well, one last question here. You say that follow the money strategy. And why should investors pay special attention to that?
This is my favorite investing thesis. I don't care if you're in stocks, bonds, real estate, whatever it is, you want to follow the money. And so let me kind of break that down and explain what that means. If you could go back during COVID when a lot of businesses got wrecked, especially the restaurant and hospitality sector, the reason they got wrecked is money stopped moving into them. That money didn't disappear. It went into other things, right? Imagine being in the toilet paper business or the Zoom online meeting business when COVID happened, right? You could have whatever economic event occur, but if your money's in the right spot where other money is going into it, you're going to be fine. And so our investment thesis is to follow the money. And there's a macro way of looking at this, and then there's the micro. And so I'll briefly touch on this. As far as the macro goes, you want to be in areas that money is moving to. How do you know money is moving into an area? And I'm talking, specifically about real estate here and what we do. Money is moving into an area when you've got four parts. You've got institutions, you've got large corporations, these are like Amazon, Oracle, etc. You've got small businesses, and you've got consumers. If you've got those four people moving to an area, then you're going to have money moving into it. So how do you know you have large institutions moving into an area? Well, this is typical hotel and skyscrapers downtown, right? So if you can go downtown, you can count the cranes. If you see hotel prices are through the roof, if you can go grab a copy of the local business journal and just see like how many hotels are setting up downtown or plan on developing in a city, that's a really great indication of a lot of large institutional capital moving into an area. Nashville, Tennessee, for example, between 2010 and 2018, there was about $5 billion of institutional money that moved into Nashville, Tennessee. Right now, there's over $7 billion under construction. I mean, you take an 8-year period, and we currently have that under construction right now. Tons of money that are moving into the Nashville, Tennessee, that institutional. If you go pull up a before and after picture on Google, go Google Nashville, Tennessee skyline before and after, you will literally see the number of skyscrapers double. It's crazy. That's how you know that the large institutions are moving into an area. Next are going to be your businesses like your Amazons, your large corporations. And again, you can just grab a copy of the local business journal, look at the news, and see. Nashville, Tennessee specifically, we just built a 5,000 unit skyscraper downtown from Amazon that's going to house C-suite executives. Oracle's moved here, Alliance Bernstein, Facebook has, a big data center up. There's a lot of large corporations moving here because Nashville, Tennessee specifically is incentivizing these businesses to move here for the tax incentives. And so when you have businesses move here, you have money move to an area. And again, you want to follow the money. That third one is going to be your small business owners, right? And so if you go look at what's happening with the commercial leasing market, what is the trend in the price per foot of commercial leasing, like how available are commercial leases? That's going to give you a really good idea of how many small businesses are moving to that area. Another great indication if small businesses specifically are moving to an area is COVID revealed this environment that we all knew was there, but made it very evident. You've got business-friendly states and you've got non-business-friendly states. And there is a migration right now to business-friendly states like Florida, Texas, and Tennessee from these highly regulated states that shut everything down during COVID, New York, California, New Jersey, et cetera. And so all these small businesses are moving to business-friendly states. This is something to be considered if you want to open up a business in the future. These states make it easier to do business, which means people are going to go there. And when people go there, money goes there, which brings me to my fourth part, which is the consumer. How do you know consumers are going to an area? Well, it's pretty simple. What does the population growth look like? It's very, very simple. It's easy data to get. You want to be in an area where people are moving. And if people are moving into that area, then money is moving into that area. And so Nashville, Tennessee has been one of the top 10 fastest growing cities in the United States the past 7 years. And so we know that there's a great story there that's causing people to move. That pretty much sums up the entire macro piece of it. Money moving into an area. And the next is the micro. And I'm not going to spend a ton of time talking about this, but when you get to the micro, now we're talking about specific asset classes. I was talking and joking about the toilet paper industry with COVID there for a little bit. You've got to now decide which asset classes are money going to continue to move into versus not continue to move into. And for us, we see a great runway for entry-level housing. Everybody's seen the affordable housing crisis on TV. Depending on who you talk to, we're 5 to 6 million homes short. We only build about 1.2 million homes a year. So there's quite a bit to catch up there. The supply chain issues, I'd say they're about 90%, back to normal. There's still some stuff that's taken a while, but that's limited supply from getting to the market. And you've only got about 10% of these homes being built. In other words, 10% of those 1.2 million homes per year being built are entry-level housing homes. But you have 33% of the home buying demographic chasing those homes. Millennials that are having kids that are at prime home buying age. And there's just too much demand. 1/3 of the home buying population chasing 10% of the inventory. That tells me there's a big supply and demand imbalance. And that's an asset class that I want to be in. So follow the money into the asset classes where money is going into.
Well, thank you so much, Brandon, for being with us. Very informative conversation. And folks, be sure to get in touch with Brandon at HBG Capital. Thanks, Brandon, for being with us today.
Hey, thanks for having me.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.